afternoon and welcome. We are at Risk Minds, Boston, USA, and today we're with Mike Thorfinnson, who is the Chief Risk Officer and Chief Administrative Officer of TD Asset Management. Mike, welcome. Thanks for spending a few minutes with us.
Thank you.
Perhaps if you could just tell us a little bit about what you do as a day-to-day basis in terms of your work responsibilities.
Sure. I have a bit of a hybrid role. So TD Asset Management is a division of the Toronto Dominion Bank, and as part of the asset management or investment management group, I look after a number of middle office and shared services functions in the front office. So that includes risk management, operations, business services, client support, product development and management, trading and implementation, and some business support groups. So it's kind of a broad spectrum of the shared services support groups that support our investment management and our mutual fund business units.
Great. And Mike, you're here at the conference to talk about profitability, and certainly in this environment it would seem there are challenges. Can you elaborate a little bit on the challenges TD Asset Management faces in this space?
Sure. So we've had a number of things which have impacted our business the last number of years and continue to impact our business from a profitability standpoint. I'd say the number one thing would be regulation, in the sense that following the crisis of 2008, there's been a lot of additional regulatory requirements placed on us as a business from a number of regulators. They include things like anti-money laundering requirements to collect additional information from clients, additional governance requirements for scrutiny over mandates, over suppliers, over vendors, over contracts, a lot of additional reporting, which is required by regulators with respect to operational risk and errors and things like that. And they've all added a sort of layer of expense, an expense burden which is permanent in the sense that it's not going away. So that's something that we have felt, and there are additional regulatory changes on the horizon with Dodd-Frank and the Volcker Rule, which can also impact the expenses in our business and therefore our profitability.
So how is management reacting to this in terms of calling attention internally to profitability, attempting to overcome those challenges?
Right, those are great questions. There's a lot of consternation around the fact that in this environment where we haven't seen a huge increase in markets the last few years, or significant increase to really compensate for the increase in expenses, there's not a lot you can do to really control those expenses. They are a permanent increase in your expenses. So the more you can automate, the more you can develop efficiencies and leverage off of other groups which provide governance functions, then the better off you are in terms of controlling expenses. But it is recognized by management that there are some things which are not going away. So.
And how does management look at profitability? Because certainly for some investors, perhaps that's a return earned over a period of time in terms of investment. Is that the same sense in terms of management expectations, or is there more of an immediate sense around profitability?
Yeah, it's a really interesting concept, because in the investment management business, profitability should really be measured over a market cycle, in effect. So, say 4 years, in this cycle it would be a little bit longer than that, but to capture the ups and downs of a market, since revenues are generally driven off of asset levels, you need to view profitability in the context of the ups and downs. In this environment where there's so much focus on costs in a low interest rate environment by a parent that's a bank, there's a shorter term focus. So where traditionally you'd have more flexibility to invest in things with a payoff which may have a time frame of a few years, there's less tolerance for that type of investing. So if I want to make an investment in my business, in a process or a technology or something, then typically the payback period required is shorter than it used to be. And that's just because the focus from a banking entity standpoint is much shorter. Typically there's the quarter-to-quarter cycle of a public reporting corporation. And there's a focus on your operating expense ratio and your actual real increases or decreases in your costs, and they tend to be measured on very short periods of time. So whereas an operating leverage, a good operating leverage would be, say, 2%. Your revenues are growing at a rate 2% higher than your expenses. In this environment, the the desire is to have not only good operating leverage, but zero growth in your expenses.
Mm-hmm.
So it's not one, it's both, which
Mm-hmm.
makes it very difficult.
Is there a sense of potentially taking on too much risk to compensate for attempts to increase profitability?
Not really. No, there's I'd say the risk tolerance has actually declined. You know, our focus from a risk standpoint, if we look at clients first and foremost, is to identify areas where perhaps the risk tolerance of clients is at a mismatch with the investments they're in. And we think that that's one of the key risks actually in our business right now and in the market right now, where, and the prime example is bonds. With rates as low as they are, people have traditionally invested in bonds as a safe haven, as a very secure investment with limited volatility. In this environment, it would take a very small increase in rates to see a significant volatility in bonds and a loss in bond portfolios. So we think that a lot of investors who believe they've invested conservatively have actually invested more aggressively than they realize, and that to us is a concern. So the focus is more there as opposed to, hey, how can we leverage our portfolio, what we offer to clients, and to actually increase our revenue base. So.
And how do you communicate to management in terms of the trade-offs between risks and profitability, and get management comfortable that these issues are being attended to appropriately?
They're very, in our organization, I know they're very clear lines of communication and escalation, and there's a real seat at the table for risk people like myself at the management level, for our CIO to be at the table, raising the alarm in terms of investment themes and risk tolerance, and those things are listened to, and we actually have an environment where we can react fairly quickly in terms of educating people and galvanizing lots of people to action. So it's effective.
Thank you. And one last question. In terms of the landscape of key risks or key threats, we've talked about profitability, we've covered a lot about market conditions, increased regulatory challenges. Is there anything else out there that...
Sure, there's a couple things. I mean, from a regulatory standpoint, we've talked about that key risk. We've mentioned bonds, which is an investment risk, and low interest rates. The two other things I'd mention, one is a perpetual worry of mine as the Chief Risk Officer, and that is the failure of systems. So although we have very good systems, they're well governed, there's a lot of effort that goes into managing them. My worry is, and has always been, that we get a failure in a system that's so complex and it's so intertwined with other systems that we get in a situation where it's very difficult to recover in a normal time frame and bring people back up to where they were. So that's a problem with the way, I'd say, the way we've built systems to be faster, more interconnected, more interdependent, and we've rarely faced a situation where we get a system down for a long time that really impacts a lot of other things. So that's one. That's in some ways a permanent worry, but it doesn't go away. I've never forget about it. Cybersecurity can be brought into that as another theme as well, because that can definitely impact systems in a way that, or a cyber threat, which could have a domino effect on other systems. And then the other thing I'd say from a risk standpoint in the business would be social unrest in the world. So there's a lot more rioting going on. There's very high youth unemployment. The Turkey would be the prime current example where we've seen a significant drop in that market, primarily because of social unrest. And we don't lose sight of the fact that that can have a ripple effect through the world and markets and returns. So that's another investment theme and an investment risk. But those are the three: it's regulatory, operational, and investment.
Thank you, Mike. Certainly a lot of good information and good advice for us. I appreciate you taking a few minutes to share with us.
Thank you.
Thank you. Take care.